Turn up my volume a little bit. Here we go. Okay. Got just a couple of chapters tonight. It's more like one and a part of a chapter tonight, but the one chapter's
Are you
pretty
in Spain
major.
right now?
Oh, and I am in Spain
Mm.
right now. So, which is my fifth and final country before I head back to Florida for a couple of weeks for a break.
So Spain is your final country?
Yes, on this leg.
Oh.
Yeah. So, um, I'll be there for a couple of weeks, and then in December, be flying to Manila to see my dad for a week. So, which starts the Asian leg of the trip. So, be going to the Philippines, and then from there I'll fly to Thailand for a month, and then from there a month in Vietnam,
Well,
and
when you
then
gonna
from
be in
there,
Vietnam? When you gonna be
oh,
in Vietnam?
in Vietnam, let's see, I want to go to um, oh, what is it? Um, I have to look at my itinerary, but
Yeah,
I'm
you
very
should be.
excited about
You should be.
going to Vietnam.
Yeah, you should be in Asian country around February because
Ah,
it's the Lunar New Year.
yes, I'm very excited about that. I have to, I am fairly sure I'll be in Vietnam for in February. So I hope to see a lot of the cool celebrations and things like that. So yeah, I'm excited
I
about
think
that.
Philippines and Thailand they do celebrate that too.
Yes, I've heard that as well. I'm excited that I'll be in Thailand in December. So I'll be which is funny because I know Christmas it may not be as big there, but I heard they celebrate it anyway since a lot of
Mm.
visitors
Yeah.
celebrate Christmas. Let's see. I think I'm thinking in my mind if I remember Thailand December, and then I'll probably be well, I might be in Vietnam January, February. I have to see how long I'm in Vietnam. And then after a month there, I think I'll be in Cambodia over there. So it'll be interesting to see how teaching is going to look like when I'm in Asia. So I've taught in Europe before, but haven't taught in Asia yet. So I think the time change is going to have some advantages and some unique experiences, especially with the big time difference.
Yeah,
So
because like for example, it's right now like we are in evening and over there is daytime.
yes, that's right. Which actually should work out for me. So I could teach my night classes and it'll be the daytime when I'm in Asian countries. So I think it'll work out. Let's see, right now, it is midnight here I'm in specifically in Cadiz, Spain. So it'll be fun to see how that works out.
So you have to be early bird.
Um, yeah, it's not bad. I think the hey Lou, welcome, good evening. I think the biggest weird class time is my Friday night class because I'm the only one that teaches a Friday night class live for FSCJ. So when it is 10 p.m. in Jacksonville, Florida, it is 4 a.m. in here in Spain. So I taught my principles of finance class on Friday last week, and it's 4 o'clock in the morning for me. So it amazes my students that that's the time that the class is.
That interesting.
Yes, it is very interesting. I mean, it's class already starts at 10 p.m. So it's live from 10 p.m. to 11:30 p.m. on Friday. But then that translates to 4 a.m. for me. So it's fun. All right. So we're going to revisit one of the chapters that we talked about before, which is behavioral and technical analysis, behavioral finance. So we talked about behavioral finance last time, but now we're going to use the larger chunk of the chapter, which is technical analysis. Now, I'll preface it by saying that technical analysis, at least according to a lot of empirical data, is kind of hit or miss. A lot of data leans toward that technical traders cannot beat the market. So with all the fancy tools and charts and so many different techniques, and believe me, there are more techniques that you can imagine. Every time I go to an investment conference, there are so many different new technical trading techniques that, again, people use to make money. Um, but I don't. I use a little more statistics rather than technical analysis in trading. Although one of my favorite trading firms I like to follow, which is S&P Capital, they're very good technical traders, and they got some young people there that probably make seven figures a year just trading using technical indicators every day. And again, nothing wrong with that. If you have a playbook that works for you, and you have that skill and patience to be disciplined to stick to your playbook, technical analysis can work. So, despite a lot of people that and data that says otherwise. So, all technical analysis is, I guess, overarching is that you don't really care too much about what the company does, or you can ignore whether it makes profits. You ignore what it makes. You're basically product indifferent. You don't you could trade on some random symbol you've may not be familiar with, not even know what they make, but you are really trading on price and volume data. You are really trying to forecast the direction up, down, sideways of stock prices. This is really what technical analysis is. What you guys are doing in most of your homework, and for the bulk of the information you get in a lot of finance classes that I teach, is falls under the other camp called fundamental analysis. So you consider profits, you consider the nature of the business, you consider revenues, you consider all those ratios that you guys have been smartly computing. But in technical analysis, you're looking at charts and figures. So you can apply it to the market overall. You can do market analysis with technical analysis. You could apply it to individual stocks or portfolio. And I got a cool little video link that talks about, that uses an example of technical trading to analyze an airline stock. So Tony Zhang, which is a young analyst that they feature on CNBC from time to time, has a pretty nice one. So the methods are easy, but it's a real art to interpret what the signal is telling you when you're using technical analysis. And the one big weakness is they're after the fact. So a lot of times you'll catch the pattern, but it's already happened, which is why AI these days, which they have AI algorithms that I've seen at a lot of investment conferences and trade shows these days. That's like the hottest thing. Computers are just faster than the human brain right now to calculate technical moves almost instantaneously. So that way you don't have to wait and analyze which move you think the stock is going to do. And with the technical analysis of AI linked to the execution buttons, they could probably execute the trades a lot faster than a human can. So one of the advantages of technical analysis as a trading method is that the rules that you can use can protect you from big losses and keep you invested. So it keeps you in the market. When they rise, you can take advantage of the moves upward. Now, again, you can use these tools if your thesis is stocks are going to go down too. So let's talk about one technical tool that traders could use. One's called the Dow theory. And they basically use this as a tool to detect patterns in relationships between the Dow Industrial Average and the Dow Transportation Index Average. And so the interpretation is this: if the Dow Industrial Index rises, then the Dow Transport Index, which is the collection of transport stocks, should rise. If they do, that basically says, okay, we're in a bull market and stocks will generally be going up. If the Dow Industrial Index is trending downward and the Dow Transports Index trend downward, then it's a bear market because I guess one way you can interpret it is this is like a big chunk of the economy. These stocks in the Dow Index represent the entire economy. So if they're going down, then the economy is not going to do so hot. Maybe we could be going into a recession. Maybe it signals a bull market. Is it foolproof? Not really. Um, it's even tougher to interpret if what if the Dow Industrials go up, which they have been since April, and the Dow Transport Index goes down, say due to President Trump's tariffs. Then the Dow theory is kind of useless because they're going in two different directions. So if industrials are going up, transports go down, then industrials might go down. Is that a signal that we should sell? Maybe. What if the transports go up and the Dow Industrials go down? Then, of course, I noticed my own typo here. Then is that a signal, a buy signal that stocks are cheap, we should buy? Maybe. But again, I'm not a big fan of the Dow theory as a technical indicator, but some people like to use it. I'm not a big fan of the Dow Jones Industrial Average to begin with because it's price weighted. All right, here's another technical tool you can use if you like technical trading. This one's called the Barron's Confidence Index. So you're looking at the difference in yields paid by high quality debt, so debt that has a low chance of default, and then high risk debt, low quality debt. They usually pay higher interest rates. So what you're looking for is behavior. If you're looking for a bullish sign for the market, then you're going to see more cash inflowing into low quality debt, high risk, high yield bonds, for example. If the spread is uh, small, meaning that the difference in the interest rate you're earning on high quality debt and the interest rate you're earning on low quality debt is very small, then that could be a bullish sign. If there is a higher difference between the spread, meaning the interest rate that high quality debt pays and the interest rate that low quality debt pays, then that's a bearish signal. So problem is it's really hard to make timely market moves based on this index is because there's a lag between what actually happens and when the signal is indicated. So you suffer between the timing lag there. So again, I don't really see this one as one that I would use as a technical tool. Here's another one, the investment advisory opinions theory. Basically, you take a look at all these analysts and how they rate particular stocks. Some rate them buys, sells, holds, and then in this strategy, you take a contrary view of advisory opinions. So if analysts say buy, then maybe you should sell the stock. If a lot of analysts are saying, oh, we need to dump the stock, then maybe it's a good time to buy. But for my take is I'm kind of skeptical. You have pretty educated analysts there who have powerful tools and experience, and they at least have an educated guess about the forecast direction of securities. Doesn't mean that they're right, but they may have as good or better idea about the direction for a particular security since their full-time job is analyzing that particular security. So you have to have a compelling reason to go contrary to their research. Advanced declines, I can see this one as being kind of useful. This one's actually pretty easy technical tool to understand. What you're doing is you're just tracking how many stocks are going up versus how many stocks are going down. If there is a net increase in the amount of stocks increasing in price, then that's a bullish signal for the market. If there are more stocks going down than going up, then it's a bit bearish signal for the market. So pretty easy to interpret. So we could see advances, declines on every single trading day. Take a look here, April 23rd, we got 2,163 stocks rising in price and 874 dropping in price. So we have net advances of 12.89. So that's a bullish signal. Here's a bearish signal. There's 2,500 stocks going down. There's 498 stocks going up in price. So bearish signal. Again, pretty easy to interpret. Is it a useful tool to make a move? Possibly. If you're trading the ETFs of market indexes, yeah, it's probably a useful tool. Point and figure charts. So this is one where you're looking at support or resistance for stock prices. So if prices are rising, then that means demand for that stock exceeds supply. I mean, that makes logical sense. If prices are going down, then there's more supply than there is demand for that stock. That makes sense too. If the price breaks one of these two patterns, demand over supply or supply over demand, then there's a shift. And so that may be a catalyst for you to make a trade. So what you're looking for is visually how you interpret support and resistance levels. And you're going to have a homework assignment on this, which should be, pretty easy one to take a look at. But I think you can see here, we have a resistance line where you can see stock prices reaching this resistance line, but not quite breaking it. But then we have support lines around here. This is a bullish range. So as stocks keep on setting new higher and higher resistance lines, and the lows or where the stock finds support but doesn't break below that support is rising, then this is a bullish signal. And this is more of a bearish signal. New lower and lower highs, increased lows going down. So support is falling, and the share price is not breaking out of this ever decreasing resistance line. So that's a bearish signal. So sometimes it can be pretty easy to see, and you can make a trade from that. So during an upward trend, each high is higher and each low is higher than the last one. So for example, A, B, and EF, these are your support lines. And then C, D, and GH, those are your resistance lines. So once the price reaches the resistance line, usually there's a pullback away from that resistance line, generally. So if you see prices touch the resistance line, but then pull back, and then touch it again and pull back. Same for the bottom. Touch the bottom, and then rise back up. You can make trades simply off the bouncing of each of these resistance lines. And there's actually tools built into that are free, like on Yahoo charts, where you can set up resistance lines, and you can see the bouncing and make the trade. So if it hits that resistance line at the top, maybe you could take your profits there. If you see it bounce on the support line, maybe that's when you want to buy. So again, you can interpret that way and use it to make trades that way. A little video of using United Healthcare as an example of resistance lines. So not a bad video there. Bar graphs, very easy to read. Their patterns are similar to interpreting those point and figure charts. They also allow you to detect support and resistance. So vertical, so right here, vertical is the range, horizontal is the close. So you can kind of see patterns here where it kind of funnels into this cone right here. And then there's a resistance line at C and D. And then there's a pattern. There's an actual name for this called the head and shoulders pattern. So you could see this repeating. Or if you see the shoulders form and then the head forms, then once it reaches a peak, could be taking profits, and then you could probably project that a right shoulder is going to be built here eventually as people take profits. Again, it's not perfect, but you can interpret it that way. It's a common pattern. Candlesticks. Candlesticks are very popular with traders. So interpreting the candlestick, that one candlestick shows the price that it opened at, the price that it closed at, and then the high and the low. So how long the shadow is to form the candle, that connects the high and low prices. It tells you the range that it was trading at. If the opening price is greater than the closing price, then the color of the candlestick body is black. That means there was a price drop that day. If the opening price is less than the closing price, that means it closed higher, then the candlestick is colored white. So long dark candlesticks are bearish because those are a big drop. Light candlesticks are bullish because those are a big rise in price. All right, moving averages. I've used these before. If you ever take a technical trading class, which I've taken before, probably one of the most fundamental moving average tools you'll have is called the Golden Cross. And again, you can look at these up for free in Yahoo Finance. If you just look on the charts, you could set up a free indicator for 50, 100, 200 days moving averages. So it's a line graph that shows you what the moving averages are for each one of those length of trading days. But the 15 to 200 days in particular is the trading tool 101. So if the 50-day average of a stock crosses the 200-day average above it, then that's a bullish move and might be a good time to buy. If the 50-day average crosses below the 200-day average, it could be a bearish signal. So usually it's called nicknamed a death cross. So for example, so we got the moving average in the blue line moving either above or below, let's just pretend the gray line's that 200-day moving average. So as it moves above that 200-day moving average, let's see. Oh, actually, this one's a little different. So daily stock price. So if the daily stock price moves below the moving average, and that usually signals a sell signal. If it moves above, then that'll be your buy signal. So you can see it like right here. You can see it, well, you can't really see it there, but you could definitely see it here where it crosses above the moving average. So again, interesting. I actually like this example better. I put a YouTube link that I found on interpreting and looking at the golden cross. I thought that was a pretty good video on that. So feel free to take a look at that. Some other technical indicators, MACD is actually a pretty easy one to understand. You can actually set this up in Yahoo Finance. But what this is it calculates exponential moving averages. What that is versus a regular moving average is that it gives more weight to more recent prices. So instead of the 50-day and the 200-day, this one will use a 12-day and a 26-day moving average. So MACD will calculate the difference between the two average. If the difference is a positive number, then it's a bullish signal. If MACD is negative, then or positive or decreasing, then it's a bearish signal. So you can add MACD to your chart as like a little add-on indicator, and you can see it move up and the MACD move up and down. So that could give you your timing for a particular stock you're looking for about when to enter, when to exit. Verification of technical analysis. Again, going back to market theory, where it's hard to beat the market. So technical trading applies to the weak form of efficient market hypothesis. So markets are efficient because even if you do technical analysis, you still can't beat the market. And so it fits in that weak form of the efficient market hypothesis. So again, I probably would lean, if I believed in the efficient market hypothesis, I'd probably lean into weak form and semi-strong. But there's been tons of research out there that say technical analysis doesn't really work. You can just simply invest in the S&P 500 and match the market and beat a lot of technical traders out there. So, and the reason why technical analysis is challenging to beat the market is because everybody has access to the same information. It's not like 20 years ago where traders had tools and data that most people did not have. Thanks to the internet and very fast internet, you have a lot of the same tools that traders had years ago that now everybody can just access for free. And markets react a lot quicker. So as a piece of news comes out, it's already reflected in the stock price. You don't have that edge, that advantage anymore. A smarter way to use technical analysis is, at least I think, to supplement it with fundamental analysis. So you actually care about companies that have profits and revenues, and you can use those ratios that you've been using to analyze on your homework. You can care what they make, and then apply it to movement of the stock price. So if you, based on the fundamentals, if you have a thesis about a bullish move or a bearish move or a hold, then you can also use the technical maps to back up your fundamental thesis. Dogs of the Dow. I remember seeing this theory years ago when I first started investing when I was a kid on Motley Fool. And it's still a popular strategy today, although the data doesn't back it up. But it's a neat theory. So what you do is you take the top 10 stocks in the Dow Jones Industrial Average, the 30 stocks there, take the 10 that have the highest dividend yield, buy those stocks and own them for at least a year. Repeat the process, and after 1 year, drop those that are no longer the top 10 highest yielding stocks. So what you're looking at is the ones that pay you the most cash. Because again, you get the benefit of hopefully the stock going up, and you get paid cash along the way. Back in 2019, not that long ago, right before COVID, the strategy didn't really work because the S&P 500 returned 30% without even including the dividends, and the dogs of the Dow strategy returned 14%. Again, 14% is nothing to sneeze at. That is a superior return versus the average of the market, averaging around 10%. But there are years where the market will probably beat it. But then there could be years where the market's going to lose to the dogs of the Dow strategy. Again, it's not perfect, but if you like income, it's a solid strategy. There's a subset of this strategy called the small dogs, which I had to add in here. Basically, you apply the same strategy, except instead of buying the 10 lowest and the 10 highest payers, you actually focus on price. So you buy the 5 lowest priced dogs of the Dow. So you're looking to buy them cheap, and you're also looking to get paid. So again, not a bad strategy. Will it beat the market? It could, especially since you're going to get paid dividends, but it's not going to beat it all the time. All right, we are doing fantastic on time, and going to do our last chapter of the evening, which is what I pretty much do every day, which is what I did today and last week and the week before. And hopefully if I get a good signal, do it when I'm traveling back to the US, I guess in a month, less than a month. All right. Across the Atlantic. So I'm still researching how good of a signal I can buy, so I can still trade, and also keep in touch with you guys while I'm on the Atlantic Ocean. All right, as you go through life, always remember that money isn't everything. Health benefits and stock options are also very important. So I thought this is a fun, applicable cartoon. So Introduction to Options, Chapter 17, one of my favorite trading strategies that I've been using for last few years, several years. I remember actually when I started trading options, I was on vacation visiting a friend in China because she was teaching in Beijing. And so while I stayed in her flat, I actually was starting my first options trades many years ago. And I would love to go back to China, actually, because there's too much that I didn't get to see. All right, so what are options? Options are derivative securities. And basically, a derivative is just a type of financial asset that you can trade that is whose value is derived from another asset. It could be stocks, could be ETFs, could be futures. So options are just like futures are just derivatives. You can price them. They are priced based on the movement of whatever stock that they're tied to. These are leveraged securities, meaning that you are trading them uh, with with the ability to use less capital from you, and you're using some capital from the broker. And so that all automatically gives a level of risk, because in order to get the greater returns, you are basically borrowing some money from the broker in a lot of cases. So now there is something called cash secured trades, meaning that you do put up the capital for these, but the securities themselves, the options, are leveraged securities by their nature. So think of options, and this is I think the best way to describe them. Think of them as insurance contracts. So you could buy insurance contracts that allow you to control 100 shares of Microsoft, or 100 shares of NVIDIA, or 100 shares of Apple, without actually having to own the stock. Options are capital efficient, which is why myself and many other traders are attracted to it, because to control the same amount of stocks, you only use a fraction of the capital to do so. So an option, like I said, the best way to describe it, it's like an insurance contract. It gives you the right, if you buy that contract, to buy or sell a stock at a specified price. And the terminology for that specified price is called a strike price or exercise price. Like the insurance contracts that you pay for your car or your home, for example, they expire because you always have to renew. You have to renew your car insurance every year. I know I had to when I owned a car before I sold it this summer. Basically, I had to renew my car insurance every year, or well, yeah, every year. But I pay for it every 6 months because it has an expiration date. Same with option contracts. They have an expiration date. That right for you to buy or sell a stock expires after a certain amount of time, after which it will become worthless. So like an insurance contract has an expiration date. It's only good for a year. What do you think about the market recently since it's a bull market? Great question. Do you think it will have a recession soon? Well, uh, if we're talking about U.S. economy, excellent question. The numbers, at least the last few Bureau of Labor Statistics reports, show a weakening labor market. The last jobs number from last week shows that there are more claims, there are less jobs open. Not only are businesses not hiring, they're not creating newer jobs either. And I know my best friend, he got laid off a couple months ago. My sister's been looking for work for the last few months, so it's not that great out there. Despite that, business profits are up. So we have a dichotomy of business success, but also weakening of the jobs market, which could be one signal of recession, but business profits rising and quarterly reports exceeding expectations is not a recessionary or bearish signal yet. So inflation could be. Inflation is stubborn. Inflation is still around 3% or just below 3%, and actually rising slightly again, despite what the Federal Reserve is doing, keeping interest rates high. So we're still paying a lot for goods and services and food and other things we like to spend on. And tariffs aren't helping either. So I think that we've had a recession. My thesis was we've had a recession for a little while. Uh, what's uh, what's unfortunate about when economists declare that we've had a recession, usually those metrics are after the fact. Like economists forecast a recession that we've had a recession sometimes after we're already in it. So what they look for is at least two successive quarters of negative growth. Well, we've had positive GDP. We've had positive economic growth, slowing growth for sure, but it's still moving upward. So the numbers don't say recession yet, but I think we're in a recession because we could feel it. Prices are up, jobs are down, the housing market is stagnant. Uh, we are importing more than we're exporting, although we're making more on our exports, but I think that's uh, that's because tariffs are priced in. So a lot of data shows that a bull market can continue uh, if the numbers still support it. Right now, the financial numbers are supporting it. So unless something drastically changes, I think the bull market's here to stay for a little while. Stocks up, cryptos are going down. All right, that's another good one. Um, cryptos are temporarily down right now because if you look 2 weeks ago, cryptos are up quite a bit. I think crypto holders are a little more fickle, and they don't always have a positive correlation to stocks. So even though stocks are moving up, uh, crypto holders are taking profits right now. Also, cryptos move more dramatically whenever you hear bad news. So if you hear uh, that the labor numbers or unemployment numbers are going up, jobless numbers are going up, that's bad news. Sometimes they'll sell on cryptos will sell on the bad news. Another one is seasonality. September and October are traditionally two of the worst months for stocks out of all 12 months. September was unusually bullish. Usually stocks drop on average about around 4% uh, in September, but today was the last trading day of September and stocks were up about 3%. So this is against season, although they might make that up in October, and I'm afraid of that because I'm traveling in October and I don't want to see the market go down yet. But yeah, cryptos are down because they analysts consider that a risk-off strategy, and they use any bad news as an excuse to sell. So uh, there was a short-term drop in cryptos. You saw Bitcoin drop from like 120,000 to 110,000 in a couple weeks. Now it's back up to maybe 112,000 a coin. Ethereum, which was the hot coin at the time, which is still my favorite, it went all the way up to 4,700, 4,800. Now it's like barely above 4,000 a coin. So right now it's risk off sympathy right now. But if there's good news, like a catalyst such as the government not shutting down. The government has till midnight, or else the U.S. government will shut down today if Congress doesn't approve a budget. That could be a catalyst for stocks, possibly stocks to drop. Definitely for crypto to drop because they'll probably react more dramatically. But yeah, we're still kind of in a bullish environment, I think. But I think you could be a little more selective about which stocks would be bullish. The ones that are actually making some profits are the ones that are going to stay bullish. But the ones that are going to have trouble making money, ones that are affected by tariffs, ones that are affected by increased government regulation or competition from overseas, those are the ones that might have a little more trouble rising. So there's two different types of options, call options and put options. Let's talk about call options first. These are initially popular for folks that have never traded options before because it allows you to use little money to buy shares of stock or capitalize on upward movements of stock without actually having to buy the stock. So all it is like an insurance contract to buy at a specified strike price within a specified time period, basically before the contract expires. So think of it as a way to ensure you don't overpay for a stock. For example, let's say I want to buy shares of Microsoft stock. My oldest holding, I like Microsoft stock. And Microsoft's selling for $400 a share. I go, that's kind of expensive. I think more of a fair price would be $390 a share. So I'm going to buy a call option, which gives me the right to buy shares of Microsoft for $390 a share. And that contract expires in 30 days because I think that Microsoft stock is overvalued. So what if I'm right? What if Microsoft stock drops down to oh no, let's see. Let me reverse that. Let's say Microsoft stock is selling for $350 a share, and I think it's worth $390. And so I think my thesis is I think Microsoft stock is bullish. I think it'll rise. So I'm going to buy a call option, giving me the right to buy Microsoft shares at $390 each, and that expires in 30 days. It's an insurance contract, so I don't overpay for the stock. Well, let's say that Microsoft stock goes all the way up to $389, but then 30 days expires. Well, I just lost my investment because when you buy a call option, just like you buy insurance on your car, you got to pay an insurance premium, right? Car insurance premium. Well, you have to pay an insurance premium by a call option too. And the term to describe that amount you pay is called a premium. The name doesn't change. So it's a call option premium. And then basically my only loss would be the amount of premium I paid for the right to buy Microsoft stock at $390. What if I'm right? What if Microsoft stock goes from $350 to $450 because they've had amazing quarterly reports? And so even though Microsoft stock's at $450, that contract gives me the right to buy Microsoft stock at $390. So I can exercise that right, exercise the call option, buy the share at $390, turn around immediately and sell the share for $460, and then make a $70 profit, less whatever I paid for the call option. That'll take away some of the profit. So a call option, again, it protects you from overpaying for the stock, as long as you exercise it. Put option. All right, let's take the flip side. Put option protects you from losing money. So it's the same insurance contract, but it lets you sell a stock at a certain price in case there's losses within a specified time period. So let's say I bought my Microsoft stock at $390, but I don't, in case, let's say Microsoft stock has some sort of loss based on maybe government regulation, or they have horrible profits, or their facility blows up or something like that. So I could buy a put option to protect my investment, giving me the right to sell Microsoft stock for $300 regardless of what it's selling at. And I'll pay a insurance premium for that right to last say 2 months. And so let's pretend that a Microsoft stock drops all the way down to $50. So catastrophe, something happened. So, all right, well, it's a good thing I bought this put option that gives me the right to sell Microsoft stock for $300. So regardless of Microsoft's current $50 price, I still have the right, and someone is forced to buy my shares of Microsoft for $300 each, and I protect my investment, or at least I protected my losses from basically plummeting down to closer to zero. This is probably one of the more challenging concepts to understand: intrinsic value of an option. So the intrinsic value of an option, basically, how is it priced in the market? It depends on what the underlying stock that it's related to is valued. So again, Microsoft would be the underlying stock related to the options examples that I used a minute ago. So these are why options are called derivatives, because the price of a Microsoft option is derived from the price of the Microsoft stock. So an option can't sell, again, this is actually just straight up math, it can't sell for less than its intrinsic value. So what the option is worth as a stock. So on its expiration date, it will sell for its intrinsic value, even if it's zero. So a lot of it is based on the price of the stock, and a lot of it is based on time. So there's a time element in an option, because remember, these have a finite life. They have an expiration date. So I know it's a little confusing, but I'll explain in a minute. So the intrinsic value of an option to buy stock, and you're going to have some simple homework to figure this out too, just as an exercise. It's the difference between the price of the stock and the strike price on the contract. So if you remember my example for Microsoft, uh, say on the call option, I bought that option contract with an exercise price of $390. So if Microsoft stock goes above that, then that has an intrinsic value. So if Microsoft stock is $400 and my contract gives me the right to buy it at $390, then the intrinsic value of the option would be $10. The difference between the stock price and the option strike price. And this is also another way that people make money on call options like a Robinhood. You may not need to buy the stock, but you can trade in the difference between the stock price and the call option. So a lot of people do this where they will buy a call option way out into the future, like a year out in the future. So that way you got plenty of time to be right. And the strike price is way up there. So if there's a less of a chance for the stock to reach that strike price, you could buy, meaning pay an insurance premium on that call option for pennies on the dollar. And then if they're right and the stock rises to that point, then you make $1 for every move above your strike price. So going back to my example, let's say if I have a strike price of $390 and Microsoft stock goes up to $391, I just made $1 of intrinsic value on that call option. If Microsoft stock goes up to $400, I made $10. If Microsoft stock goes up to $420, I made $30 because again, my strike price is 390. So I'm earning $1 for every dollar move up in the actual stock price above my strike price. And here's why it's attractive. Every option contract controls 100 shares. So every $1 Microsoft stock goes up, I make $100. So if my strike price is 390 and Microsoft stock goes up to 391, congratulations, you made $100. If Microsoft stock goes up to 392, now you've made $200. Less, of course, the premium that you had to pay. So that takes a little away from your profit. But again, the premium is usually relatively small. Now let's talk about, and this will be part of your homework, in, out, and at the money call options. So an in the money call option, which is the price of the stock exceeds the exercise price. So let's say the strike price is $30 and the stock price is selling for $40, then you have intrinsic value of $10. That is in the money. And you want to be in the money for a call option. That's good. That means the stock is higher than what your strike price is. That means if the stock is selling for $40, I can exercise my call option, buy the shares for 30 and turn around and sell them for $10 a share. Instant profit. Can you please make an example for that? Absolutely. So let me just pull up a Word document here. I can just kind of draw it out. So let's say, I'll use this example here. So I've got stock A and its stock is selling for $30 a share. and I buy a stock option, a stock call option with a strike price of, let me make this bigger for you guys. You can see it a little better. So I buy a call option with a strike. Oh, good. Now you see it. I can buy with a strike price of $30. So my thesis, I think the stock is going to go up. Let's say, so let's say, let me add here, expires 30 days. So I think the stock's going up. Let's say I'm right. Stock goes up to $50 a share. So the intrinsic value equals the $50 share price minus the strike price of $30. So the intrinsic value is $20. Let's say let's say the stock price drops from 30 to 25. Well, the intrinsic value is 0 because it's out of the money. The $20 is in the money. So that's a nice way to use some numbers to describe in the money and out of the money. So if the strike price is higher than the price of the stock, in this case, the strike price is 30 and the stock price is 25. So it's out of the money. You always want to be in the money if you're buying a call option. And at the money is when the strike price is equal to the market price. So let's say stock price is 30, strike price is 30. And this is called at the money. So it's neither higher than the stock price, nor is it lower than the stock price. It is exactly the stock price. And so the intrinsic value is still 0 because you haven't made any money yet. Even if you make 1 penny, even if it goes 1 penny above the stock price, let's say the stock price is $30.01, then you're in the money because even 1 penny is still above the strike price. Now, would I actually exercise the strike? Definitely not. How do you buy option market watch? Good question. There are multiple brokers will, if they allow you, basically you have to show your experience and comfort level with options because they'll give you level 1, level 2 privileges. And multiple platforms will let you do it. Webull, Robinhood, Tasty Trade, Schwab, a lot of them will do it. Now, when I trade options, I use Tasty Trade just because of very fast executions and better pricing, and their system doesn't break down. Robinhood, I have traded options that one a while back, but I like Tasty Trade's platform and statistical tools a lot better. So yeah, depending which platform you're comfortable with. Thinkorswim is very popular, although I haven't used it. The guys that invented Thinkorswim actually, with Ameritrade, actually were the ones that actually sold Thinkorswim and invented Tasty Trade. So it just depends on what firm or platform you like using. Also, go with the ones with low prices too. If you are comfortable in your own strategies, then don't overpay for options trading. So visually, this is what it looks like. So if your exercise price is 50 and the stock price is 50, then your intrinsic value is 0, but your intrinsic value starts rising for every dollar the stock goes up. So if the stock goes up above 50 bucks, then your intrinsic value goes up. So again, a crude way of visualizing the concept. So I'm remember in the first slide, I mentioned that options are leveraged instruments. So that means you're using some of your own cash and then a lot of the broker's cash to make your trades. And so it's capital efficient. Your rates of return are significantly higher because these are leveraged. So the return on an option, usually if you are successful, can beat the return of owning the stock outright for less money too. So for example, let's say you just bought stock and stock price rises from $60 to $70. Then if you own the stock outright, then that's a 16% return. If your stock that you own goes up from 60 to 70, that's pretty darn good. But in terms of intrinsic value in an option, if the stock goes up 10 bucks from $10 to $20 a share, or I'm sorry, if the intrinsic value goes up from $10 to $20 a share, then that's 100% potential increase. So it's you can make significantly more money using this financial instrument, but you can lose significantly more money, and I've seen that as well. If the stock drops from 60 to 70, then that's a 14% loss if you just own the stock. But if you own the option contract and it drops 10 bucks, then that is a 50% loss when it comes to the options. So again, having leverage, as we learned in FIN4400, you use other people's money. Your gains are magnified, but so are your losses. Now, I mentioned that these insurance option contracts, and I'll call them insurance contracts because that's by their nature, they're kind of like that. It has a time element as well. Just like your car insurance, your home insurance, they expire. Option contracts expire, but they expire a lot more quickly. So in addition to the premium that you pay for the option, there's a time premium built in. So it's the price of what the option is selling for on the market minus what the intrinsic value is. So the longer you give yourself to wait, meaning the say 30 days, 45 days, 90 days or more, the more you may pay for the option, less the intrinsic value. So before that option expires, there's a time premium. And I'm including nights and weekends too. It's not just when the market is open. Every single minute, an option goes down in value. And that's how you can make some money actually on that. But now the passing of time hurts you. If you're buying an option, time works against you. If you are selling an option, time actually works for you. So when options finally expire, there's no time premium left. It's all expired. If you're trading a volatile stock, one that has higher implied volatility is what the term is called, they command a higher premium. So if you're trading options on Pepsi, then the premium is not really going to be that high because Pepsi stock really doesn't move that much. But on the other hand, if you're trading Tesla's a pretty volatile stock, then you can make money trading options because the premiums are going to be a lot higher because the stock price moves around a lot. And again, stock price is what drives the options prices. So this is a slide from an educational video that I took off of Tasty Trade Live, which is a great educational source. So pay more for protection on high-flying stocks whose future they are unsure of, hence a higher extrinsic value for stocks like Tesla. Again, you're paying that premium. Take a look at these actual prices, and 45 days is kind of like a good rule of thumb when you're trading options because that's the the sweet spot for expiration dates. You take a look at Coca-Cola, who's selling for $41. And if you want to buy a option contract, or it's called a straddle, there's a call and a put bought and sold at the same time. The contract is $1.65 per contract. GE, again, stock doesn't move much, $1.65. Apple, a little more volatile stock. Option premium is more expensive. So the option contract is more expensive. You're paying a higher insurance premium for that. So $6.70 per contract. Tesla, I told you, very volatile stock, moves around a lot. Of course, Tesla's worth a lot more these days, but the extrinsic value, whew, that's an expensive contract, $21.45 for just a 45-day contract. So volatility equals higher extrinsic value. So the overall price that you're going to pay for an option is this gray period right here. So the minimum is going to be that intrinsic value, the difference between the stock price and the strike price. That's this line right here. This line represents the element of time. So as time starts to expire right here, and it also includes volatility, this starts to narrow over time. Extrinsic value is not as easy to quantify because volatility goes up and down. The time element can go up and down depending on the stock. So extrinsic value, again, intrinsic value, just as a review, that's easy. That's simply the difference between the stock price and the strike price. That is one portion of how much an option contract costs. But time and volatility, the other component of what an option contract costs, that is a little harder to quantify. It's a little more qualitative because of that volatility. Time decay, that's easy to understand. The value of the option contract goes down over time. But the volatility, there's a complicated mathematical formula, which fortunately trading platforms automatically calculate for you, called the Black-Scholes model. That computes the volatility element of an option contract. So I'm just going to leave it at that because the math is a little too complicated. But when you look at the price of an option contract, just know that depending on how long of a contract you're going to buy, it's going to be worth more money if there's more time left on it, and it's going to be more money if there is more volatility in that stock. You can have a stock that's pretty volatile and a contract that's pretty short, and you can still have a contract that's selling for a lot of money. And that's because of this volatility. In pictures, it's a little easier to understand. So let's take a look at this stock. And I took this from a video called Mike and His Whiteboard. Really good video series on Tasty Trade Live. But the x-axis is how many days left till the option expires. If there was no volatility element, then basically the value of the option contract is going to go down to 0 at the end of 50 days. The y-axis here represents the value of the option. What is it selling for on the market? So in each bar, it represents the components of that pricing of the option. So the blue is going to be the element of time, the red is going to be the element of volatility. So let's say that the value of the option is selling for $5 for one option contract when there's 45 days left in the contract. So most of that of this $5 is based on time. There's a lot of time left in the contract, so there's a lot of time decay left in the value of this contract. Let's say there's 35 days left in the contract. Now the option is selling for $4, but it's still pretty high because the stock happens to be fairly volatile. But this is weird. What if there's only 25 days left in the contract? Now the contract's selling for $5. Well, why is that? I thought that contracts prices values go down over time. Well, that's true. If the stock had no volatility, then it'd probably be worth like uh, two less than $3 here. But because the stock was so volatile on this particular day, with 25 days left to go, maybe a big piece of news, maybe quarterly earnings could have done it. The volatility spiked on that day. And so now the options are worth $5 again. Now there's 15 days left in the contract. So decay is pretty dramatic around this time. Even though there's volatility there, the price of the contract is only $2.50, even with the volatility. Now the price of the contract is only worth $1. And by the time the expiration date here is the intrinsic and extrinsic value of the contract is worth 0, because ultimately it's going to be worthless if you've never used the contract. So that's why, as a buyer of an option contract, you better hope you're right, or else you'll just lose your premium, because if you never use your contract, you lose how much you paid to buy that contract. Which is why, for the most part, I always trade where I am a net seller of contracts. Time works for me instead of against me. And let me explain that. Basically, would you rather be State Farm, the insurance company, or the guy paying the car insurance? Well, I'd rather be State Farm. When I trade options, I always be the insurance company. Basically, I sell the option contracts. I collect the money, and then I decide when to pay, return a portion of the premium, and then I keep the difference. So, for example, let me bring back the handy dandy Word document here. So this is what I do every week, pretty much every day. So let's say I sell a put option contract because my thesis is the stock price will rise. So let's say, what stock to filing right now? Let's do, CoreWeave. Let's do CoreWeave. So CoreWeave is selling for, or is at, let's say, $150 a share. And I think my thesis is the stock price is going to go up. So I sell a put option contract for, let's see, $1, which in actuality, I'm selling it for $100, because again, this controls 100 shares. So with a strike price of, let's go pretty safe. Let's go of $90. So someone who's afraid that their investment in CoreWeave might drop, they can buy that put option contract for me, and they'll buy it from me for $1. So I'll receive $1 in my account, and then they have a put option contract, which gives them the right to force me to buy 100 shares of CoreWeave from them for $90 each. And I would be obligated to buy 100 shares at $90 each if that happens. If I'm right and CoreWeave stays above $90 and that contract expires, then I get to keep the full dollar. So, but as we know, decay occurs over time. So I sell the contract with 45 days left to expiration. Let's say 20 days later. let's see. So let's see, 20 days later, there's 25 days left. And due to time decay, now the contract is worth 50 cents. So instead of waiting till expiration, what I'll do is I'll buy back the contract and close the transaction early, and then I keep 50 cents. So as a seller, aka the insurance company, uh, time decay works to my advantage because every single day, including nights and weekends, the value of that contract will go down until it ends up being zero at the end of that 45 days. So, but if CoreWeave stock keeps on going up, it's going to accelerate that decay, and that's the volatility element of it. So basically, even though I didn't wait till the contract expired, I just went ahead and bought it back early because again, I don't need a home run. I just need some singles and doubles. So basically, I'll make my 50% profit, and then I will wash, rinse, repeat, and do it again, maybe with different stocks. So that's how that works. So intrinsic value, difference between the strike price and the stock price. Extrinsic value, there's a time and there's a volatility element in the pricing of options. So how do we make profits and losses? How do we derive the profits and losses if you're buying or selling an option contract? So the maximum loss is how much you paid for the option. That's one thing if you're buying options, is that at least you know what you're going to lose. You're going to lose the insurance premium you pay. And the reason why call options are very attractive to a lot of traders, and I don't blame them. I mean, the allure is powerful, is that the potential profits are unlimited. You basically can buy a call option, and there is no ceiling about how much profits you can make. So, for example, you buy a call, and you pay a $15 premium, and the stock price is $50. So in order for you just to break even, the stock needs to rise to $65. But once it reaches $66, you start making $100 every single dollar above 65 it goes up. If it goes up to $100, then that's $3,500 profit. If it goes up to $200, and so that's another 100 times, yeah, another $1,000 profit. So profits can be significant if you're buying a call option, if you're right, and you don't pay that much for the premium. But again, you got to wait for it to be right. And every single day, time works against you because if that stock never makes it to that strike price, then you lose your premium. But again, it's capped. I rarely buy options. Usually, statistically, you can make money whether stocks go up, down, or sideways as a net seller rather than a net buyer. And again, that's just from my experience and also from what a lot of the traders that I've liked to learn from do as well. So if you buy a call, your loss is limited. It's capped. So it's capped at how much you paid for the premium. If you buy stock outright, if you're not even dealing with options, your losses could be bigger because it's going to cost you a lot more money to buy the stock outright. So with options, again, it's more capital efficient. In both instances, whether you're buying stock or you're buying calls, your profit potential is unlimited because the stock can continue to rise further and further up if you are right. And again, that's a lot of people made a lot of money buying call options. We're using the right underlying stock and the right thesis that they were going up. Writing options, again, I'm 99% of the time a net seller of options. Basically, these are called, you are writing an option, and you can write it whether you own the stock or not. Now, I do both. I write call options on shares that I actually own, and I would write options on shares that I don't own, but that are related to an underlying stock. However, I don't do this, and I don't recommend anyone do this unless you have a lot of capital to work with. And these are called naked options. Don't do this unless you have a lot of money. Uh, if you don't own the stock, then naked option writing is not the way to go. There's a way around that with using a minimum amount of cash and limited losses. Like you could cap your losses if you buy and sell an option at the same time, which is what I do. So the first one, and again, the rest of a lot of these slides are strategy. So, and this isn't in your book, but I like to go over it to give you a real education on the power of options and also the versatility that they give you, because there's so many different strategies depending on what you want to do and how you can react to the market, whatever the market gives you. So to write a covered call, and this is probably the basic one, and probably one of the more pretty much a safe, pretty safe bet. People make a living in retirement just doing this, and it's a brilliant way to do it. And your losses are pretty much covered, minimal at best, if there even are losses. So to write a covered call, just buy the stock and then sell an option against it. So it combines being long in the stock, meaning actually owning the stock, and it gives you uh, extra income on the stock that you already own, even if the stock doesn't pay a dividend. This works well with stocks that don't really cost a lot. So stocks that have low prices. Now, you may not get as much of a premium on stocks that are kind of low, but what it does, it caps your upside, but it gives you income. So your profits are capped uh, at whatever the strike price is of a particular stock. Naked call, basically you just sell the call. So your gains are capped, meaning that you basically are making income in the hopes that that stock will not reach that strike price. So the danger is you don't own the shares of stock like in a covered call. So you would be obligated to buy shares of the stock and give it to whoever owns the contract if the price of the stock goes up. It's going to be very expensive for you. And the risk is unlimited because who knows how high that stock is going to be. And so let me show you an example, because I know this is going swimmingly in your brains right now. So here's a covered call. This is why I do like this. I actually have trades that look like this too. Covered call. So I buy 100 shares of a stock and let's see, $10 a share. So that equals $1,000. I sell call option to sell those shares. So all 100 shares at a strike price of, let's say, $15. So this is why this is a brilliant strategy. And I've talked to a lot of senior citizens and investment conferences that make a great income doing just this and wash, rinse, repeat. So here's how it works. So if the stock never reaches 15, keep the premium. So let's say I sell the call option for $1. So if the stock goes all the way up from $10 to $14.99, I still get to keep the dollar if the option expires. Let's say if the stock goes up to $16 a share. Here's what happens. All right, you lose the 100 shares. You get $1,500 because again, you sold it. You promised to sell it at $15 a share. Basically, whoever you sold that contract to is happy because they get to buy 100 shares for 15 bucks when the stock is worth 16. So you missed out on the extra dollar gain. But the thing is, you bought those shares for 1,000. You've locked in that you a $500 profit, and you still keep the dollar premium. So what happens? Well, right now you got $1,500 sitting in your bank plus an extra $100 in premium. Just go out and buy 100 more shares. And then you can uh, wash, rinse, repeat, sell another call option, say with a strike price of $20. And then if it never gets at $20, you can keep the dollar and then sell it again the next month for $1. If it never goes up to 20 bucks, sell it again. If it goes up to 20 bucks, great. That means you bought stock for $1,600 and then you sold it for $2,000. You made your profit, and then you can do it again. So the covered call strategy is a consistent way to make some money over and over again with the same stock. Puts, again, mirror image. You're trying to protect shares by buying or selling a put. So if you're buying a put, you're anticipating the stock is going to decline. If you are right, then the value of that put goes up because the intrinsic value goes up. If you're selling a put, like I do, I'm anticipating the stock price is going to go up and I get to keep the premium. Let's see here. All right, so how do you profit or lose money on puts? So the profit or loss profiles from buying a put and writing a put, they're mirror images of each other. And again, this is a nice little graphic on that, but skip that. All right, so what is a protective put? So it combines buying a put, buying a stock to protect your losses. So let's say if I bought Microsoft stock again for 100 bucks, and I could buy a protective put that allows me to sell it at 90 in case the price goes down, then I have the benefit of minimizing my losses to $10 a share. But I still, since I own the actual stock, I have unlimited profit because Microsoft stock could go to the moon. It's probably not, but it could. So if the price of the stock goes down, say from 100 to 90, that's okay because I'm protected because the intrinsic value of the put starts to go up and it offsets the loss of the stock going from 100 to 90. So this is how a lot of the big boys protect themselves from losses is they'll buy puts to offset any actual losses in the price of the stock versus what they bought it for. Now, the only drawback is if you're buying a put, they do expire. And once it expires, you have to buy another one to protect yourself again. One way you can take a look to see if there is a bullish or bearish sentiment on a stock, it's the ratio of puts to calls. So if there is a higher ratio of puts to calls, then it's a bearish look. If there is a lower ratio of puts to calls, it's a bullish look. So this is an additional technical indicator that you can add to your technical indicator toolbox. And I think there's a homework problem similar to this. All right, leaps. I remember when I was first introducing myself to options, the safe way, then I bought leaps in cannabis companies, marijuana stocks. Basically, you could buy call options that don't expire for a couple years, so the decay is very slow. And you could buy them pennies on the dollar. So the biggest disadvantage is if you're buying a leap, your capital's tied up for a year or more. And so you better be right. Probably the biggest advantage to leaps, which is why a lot of people have made a lot of money, is that they picked the right ones and they were able to buy them really cheap. So if you're buying a leap option, it could just be pennies, less than $1 for the contract. And hopefully you're right, because if the stock price finally exceeds your strike price, then again, you're going to make $100 every single dollar it goes up. So for a small investment, you can make a lot of money over time if you're really patient. I am just not that patient. Chicago Board of Options Exchange is more historical. It's the first and a major secondary market in options. So you can look on the tables of the Chicago Board of Options Exchange, take a look at the open interest, although your trading platform will probably already have open interest. You want to look at heavy open interest because it shows liquidity. And that's my number one rule when I'm looking for stuff to trade. I want something that's really liquid, that's highly traded. In the not so old days, option contracts were traded only once a month. They only had 1 month expirations, which is the third Friday of every month. But now, and I'm going to modify this. I trade monthlies and weeklies now. But the longer out you do your option expiration, the more time you can fix it or what's called managing the position if things go wrong. Like if the stock price exceeds your strike price in a negative way. Besides stocks, you can actually also trade options on stock indexes too. So like the QQQ, the SPY, the SPY ETFs. I've got a trade in the Russell 2000. I've got a trade in the biotechnology ETF. So what's nice about these is that since they're not individual stocks, uh, all of your trades are settled in cash in case something goes wrong. And another thing is that they're very liquid, meaning that you're going to get a fair price on buying and selling options on index funds instead of actual stocks. So buying a stock index, it's just like buying a call option on a stock. You are taking a long position, meaning that you're hoping that the stock price will go up. If you're selling a stock call, that means you're hoping that the stock price goes down. So you're taking a short position, or you're hoping that the stock price stays about the same. So you get to keep the premium and you hope that you never have to sell the stock. Stock index puts. This is another way to protect yourselves. If you buy a put, they go up in value when stocks go down. So sell a stock index put if you think the market's going to go up, because your strike price is never going to be touched that way. So again, if you think that the market's going to go down, buy a put because they go up in value if markets go down. If you think that the market is going to go up or your index ETF is going to go up, then sell a put. That way you can collect money and keep a premium if you think the market's going to go up. You can also do options on currency. I actually don't, but this is like a derivative on a derivative. You could do put and call options on foreign currencies. What I do though is I'll do put and call options on Bitcoin indexes or cryptocurrency company indexes. That I do trade with. You could do puts and calls on bonds, which I don't do that. Maybe an index on bonds like TLT. But if you think interest rates are falling, which right now they kind of are because the Federal Reserve lowered interest rates a quarter point over a week ago. So you could buy a call option in anticipation of bond prices going up. If you think interest rates are going to go up, which really is not the environment right now, you could buy a put option on bonds. So you can speculate using options on interest rates going up and down. So if you follow what the Federal Reserve is doing, you can speculate using options on interest rates. Let's talk about that. All right. The last 5 slides, and again, there's so many different strategies, but I'm going to just go over just basic option strategies, which again, they don't cover this in your book, but I want to show you basic option strategies that you may be interested in actually using in your own trading. So the 5 that I'm going to do here, I'm going to mention and focus on ones that have a limited or a capped loss, which is important if you're thinking about trading options. So the covered call we've already done. Then we're going to talk about straddles and strangles, which have unlimited risk, which is not great, although that gives you the most flexibility. And then vertical spreads and iron condors, and then iron butterfly. What's great about these examples is that I'm going to show them to you in pictures, so it's a little easier to understand. So C stands for call option. P stands for put option. The little red or the little blue circle is going to be the stock price. Okay. So this is a short straddle. This is when the call option and the put option both have the exact same strike price. So if the stock price, which is represented by the little blue circle, goes up, then the call price increases. So this value goes up, which is not great, because that means it's going to be more expensive for you. But the put price decreases, so this is going to be cheaper for you to buy. What if the stock stays right here, stays the same? This is ideal if you are selling a call and a put, because time decay works to your advantage. Ultimately, when this goes to 0, then you win. What if the stock goes down? Then the put price goes up, and that's not that. The call price decreases, that's good. They kind of offset each other. Theta decay will still work in both cases. I've never done this straddle just because I like to focus on theta decay. Sorry to confuse you. Theta decay, the Greek term theta refers to the time decay. That theta is actually the name for time decay in option speak, by the way. Sorry for not defining it. So if you're buying or selling a call and a put option together with the same strike price, this is a strategy. But again, biggest disadvantage is that there is unlimited risk to the upside or downside. So I don't use this strategy, but it is easy to understand. A strangle, this is also easy to understand. This is easy to manage as well. So a strangle is when, again, you are the insurance company and you are a net seller of option contracts. You're going to sell 2 of them. I'm going to sell a put and I'm going to sell a call and I'm going to collect a premium. The strategy here is we want to sell the strike prices of the put and the call as far away from where the actual stock price is and keep it in the middle as much as possible. The reason why is because you don't want the stock price to breach or touch your actual strike prices. So what a strangle does, it combines a short put, meaning we're selling a put option, and a short, which means we're selling a call option, and we're creating a zone of profit here. The risk is undefined, meaning it's unlimited. There is a risk you could lose. There is no cap on how much you could lose if the stock price moves against you on either side. So If at expiration, the stock price stays or doesn't touch your strike price here or your strike price here, you get to keep the entire premium. That's ideally what you want. You want time decay or theta decay. Like if I sell these two strikes for $1 and after 45 days and it expires and the stock price stays in between them, then I get to keep the whole dollar. So that's what a strike is. Vertical credit spread. This is my bread and butter. This is what I trade the most. I trade mostly these, but I have a few trades in these. So here's the setup. This is basically how to collect a premium as the quote unquote insurance company, but to cover your ass by capping the maximum amount you can lose. So on the put side, I sell one out of the money put, meaning that out of the money means it's below the stock price. And then to protect myself or to cap my losses, I buy a put below the strike price of the one I sold, just further out. So this is a bullish assumption. So if my thesis is that the stock is probably going to go up, like CoreWeave, for example, and it never touches this one and definitely not this one, then I sell this for a credit, meaning I sell it for an insurance premium. Say I sell it for $1. I buy this one for $2 and I sell this one for, I'm sorry, buy this one or sell this one for $2 and I buy this one for $1 and my net credit is $1 that I collect. Then as long as this stays above this strike price, I get to keep the whole dollar. If the stock goes up, then the faster the decay is going to be, or the extrinsic value is going to be, it's going to drop, and I can actually buy it back a lot faster for less than what I collected. So if I collected $1, the stock price goes up, I can buy it back potentially for $50 or for 50 cents pretty soon. On the call side, it's very similar. We have a bearish assumption. We think that the stock price is going to stay where it is or go down. So as long as the stock doesn't touch these calls that I sell, I sold this one and I buy this one, and net, I collect a premium, positive premium. As long as the stock price stays below the strike prices of these guys, then I get to keep the premium. If the stock price drops, I may be able to buy it back for less than what I sold it for. So this is again, bullish premise. This is a bearish premise. In either case, I am selling to collect a premium and hopefully buy it back for half. I mean, sometimes I have let it expire worthless so I can keep the whole premium. But for the most part, I usually don't want to take the risk that something could go wrong and just for a few extra dollars. An iron condor is basically this one, except you're combining the two. So unlike the strangle, where you have unlimited potential loss on this side and on this side, the iron condor is great because by buying a put and buying a call on both sides, you could cap your potential losses. Ideally, you want the stock to stay in the middle here. You don't want the stock to touch the put or the call side. So if the stock goes up, then it becomes a little more dangerous on this side because the value of these calls start to go up, but the value of these puts go down, so that's good on this side. If the stock price goes down, then these become more expensive and these become less expensive. So it gets a little scarier on this side, but becomes a little better on this side. So I actually have one of these types of trades going on with Boeing right now, because initially with Boeing, I sold the put option because I was bullish on it. But then it started moving down a little bit. So I sold a call a call and bought a call on this side, these two wings, and put Boeing stock in between them right now. So there again, there's ways you can adjust so that way it minimizes how much you could potentially lose. Then there is an iron butterfly, which is the last slide today. Basically, it's the same thing as this. The only difference is the put that you sell and the call that you sell are straddling the middle where the stock price is. And the reason why this is an attractive strategy for some people is that you get to collect more insurance premium this way by straddling the strike price. And then you buy a put and you sell sell a put and you sell a call just to put a cap on how much you could potentially lose on either end. So again, I know this is a lot that you took in for one day, but I highly encourage you, take a look at my supplemental packet that I wrote, a Word document on options, which I think is a little easier to understand than the way that the book puts together. And it covers pretty much what we covered here tonight. So before we go, we have any questions? By the way, I got an awesome text from one of your teammates that you're catching up to my amounts in Market Watch, and I love that. I'd like to see teams beat me besides beating each other. Again, you do not have to beat my portfolio. You just need to beat each other for the bonus points. All right. Any other questions? All right. Thanks. Have a great week, everybody. I'll post the video after it processes in the next couple of days. Is this the last class? No, actually, that would be next week because we have to talk about futures. So it'll be short. So I think futures is the last chapter. So this is the next to last class. So next week will be the last class. Yeah, man, it's coming up, isn't it? I think the all the assignments are due October 12th. Yeah, man, time is flying. Hey, absolutely. Yeah, definitely keep track of my positions. I need to keep track of positions too. Good. Well, great. I'm glad it helped. Um, oh, my favorite background is coming up next week. That's right, Mariah. Yes, you remembered. Yeah, I always use my favorite one for the last week. All right, awesome. All right, well, I'll see you guys next week. Take care, everybody. Have a good evening.